So we did touch on, here's all the the requirements for these, and we're going to touch a little more on filing requirements now. So a 941 is what we usually refer to this as. It's the form number. The 941 is your FICA and your income tax withholding. Generally, it's done on the form 941, and it's generally done quarterly. So it's due on the last day of the month following the end of the quarter, and that is, for example, between January 1st and March 31st, that's due, we said the last day of the month following the end of the quarter, that's April 30th. And it follows suit between April 1st and June 30th. That calendar quarter is due July 31st, and so on as we get to third quarter due October, fourth quarter due January 31st. So those are filing requirements. That report has to be filed by that date. For the 944, this is a little bit of a different version of what we're used to as a 941, and it's only allowed if the IRS notifies you to file the 944. That is done on an annual basis. You do that just once a year. It's due the last day of the month following the end of the year. So for our January through December, that's due January 31st. And generally, these folks are ones that it's $1,000 or less of total FICA and income tax withholding liability are the ones that qualify as a 944. But here's the kicker. Those payment requirements don't change. And we're going to talk about payment requirements in just a second, but let's say you have somebody that owes more than $1,000 and the IRS still thinks they're a 944 filer. Guess what? You will do that report once a year, but they may still have to pay every month. So it does not change the payment requirements. The 945, another version of a report. It is used pretty much for income tax withholding for non-payroll payments. So backup withholding we talked about earlier for our contractors. So you have maybe a Form 1099 or W-2G if you're taking taxes out of gambling earnings. Those are all going to be reported on the 945. That has an annual filing requirement as well, and you kind of think along terms of the W-2 or 1099 forms. Those are all due in January now, by the way, because of our new changes in 2017. But all these guys, the reporting form for the income tax withholdings for if you're taking taxes out for those, all by January 31st. So as we talk now about our federal unemployment tax, that is a 940. You're going to start seeing a theme that most of these are a 94 number for a lot of these reports. It's due the last day of the month following the end of the year for that 940. So again, we see January 31st. And this is the funny one. Again, we're going to talk about payments in a second, but I always thought this a little odd, is the IRS always seems to want payments very quickly. This is the only one that payments are not due until you reach $500 of liability in that quarter. So an example I can give is if your first quarter you're only at $100 liability, it's not due yet. Second quarter now you've accrued, let's say, $400 liability. You still don't have to pay it yet. But in third quarter, if you're now at $600, okay, that's when you have to pay it. If you never reach that amount, then you just pay it at the end of the year along with the form, as long as you're not over $500. So it's a little different in the way that they consider the due dates of those payments. Again, reminding you there are numerous state payroll tax considerations, so we don't want to lose track of that as we're worrying about their federal issues. When states have withholding, unemployment, workers' compensation, many other issues that you may have to consider. So be aware of those compliance concerns for your state, since sometimes those federal problems go hand in hand with state problems. So to recap, the most common type of filing, usually it's the 941 is the most common. So if we look at payments on that, well, that is the FICA withheld, Social Security Medicare taken out of the employee's check. It's the income tax withheld. Now those two first items, because they're taken out of employees' checks, I'm going to recap again, that's called trust. Withheld in trust funds, you're going to see that term a lot. That's where the idea comes from, is you're supposed to set it aside, you're acting as the government's collector, and you're not supposed to spend it. Then you add in the employer's share of the FICA and Social Security Medicare. That is not a trust fund. It's a portion they still owe, but it's not a trust fund. What are now the deposit and payment obligations? We talked about filing requirements, so you kind of have two different requirements for somebody, the filing and the paying. So they have to deposit the income tax withholding and FICA monthly or semi-weekly in almost every case. But the timing depends on the date of the payroll. So what that means is, let's say We're in the month of June. We happen to pay a payroll on the last day of June. For most monthly filers, that's going to be due July 15th. If we're in the month of September and we pay on September 30th, that is due in October 15th. But let's say that you waited a day and now you're paying that payroll on October 1st instead. That's actually not due until November 15th if you're a monthly filer. So that's where the timing depends on the date of the payroll. The date you actually date that check is what determines it. 941s are generally monthly, so it's due the 15th day following the month that payroll is dated. And employers who have more than $50,000 liability in their look-back period, we'll talk about that in a second. If you have more than $50,000 liability, in our office we actually call them frequent flyers. They get to pay a lot more frequently. So if you have, what the look back is talking about is they look back, of course, not given perfect logic, they don't look back in a calendar year like we would. They look back from like fall to the next fall, and they say, okay, over this time frame, oh, you had more than $50,000 total liability. So that's withheld FICA, matching FICA, withheld income tax. Then you will be turned into a frequent flyer. They send you a letter and you're going to have to pay semi-weekly. So if you make a payroll check dated on, now mind you, day of the week, Wednesday, Thursday, or Friday, you have to pay that payroll obligation by the following Wednesday. If you make a payment Saturday, Sunday, Monday, or Tuesday, you have to make it by that Friday. So that's our frequent flyer program. To make it even more interesting, if an employer reaches more than $100,000 of liability, so again, the combined liability, on any day, even if they're normally a monthly or semi-weekly depositor, they have to deposit that amount by the next business day. And it doesn't matter what their normal payment schedule is. Any amount over $100,000 next business day. Now, all these payments, they're all required to be paid by EFTPS. That stands for Electronic Federal Tax Payment System. All of them are required to be paid in that manner. So if you have a small employer, now these are the only guys that are exempt from this. Everybody has to pay by EFTPS or they're going to penalize you. A small employer, less than $2,500 for the quarter, they can pay with a report. Here's my caution though. If they go over even $1, so let's say our little quarterly filer, he pays one extra check that quarter. So he has $2,501 of total liability. Guess what? They're going to say, oh, he should have paid monthly. We're going to penalize you for month 1 and month 2 and month 3 because you didn't pay him on time. So a lot of those, just as a little practice tint, you might want to go ahead and have them pay monthly no matter what, because it may keep that from happening in the future. So what are those penalties I referred to? Penalties for failure to deposit timely. You don't pay that deposit on time. I just told you when they're due and you missed it. That's a graduated penalty. So within just the first 1 to 5 days late, it's a 2% penalty of the balance. 6 to 15 days late, it jumps to 5%. And get this is barely over 2 weeks' time. That's 16 or more days late, 10% penalty. Now they're going to throw on a bonus penalty. If you made the payment directly to the IRS, like they wrote the check to the IRS and didn't do it EFTPS, or they paid it with the return, and they're more than that $2,500 grace amount, they get in a bonus 10% penalty. And if they send them a notice and they go ahead and they pay within the 10 days of receiving that notice, they'll tack on just 10% extra on top of that. So you can see where these bonus penalties are going to start adding up really fast. If they mess up and they did not pay it within the 10 days of that very first notice, that penalty is instead 15%. So it really can add up quite quickly. Just to kind of add a little more pain to that, they'll have additional types of penalties. So penalty for failure to pay. This is in addition to the last one, the failure to deposit timely. Penalties for failure to pay means they did not pay when they were supposed to. It's 0.5% of the amount unpaid for each month of non-payment. And that's going to reach a maximum penalty of 5%, which doesn't sound too bad, but if you remember our previous screen, they could have a 10 and a 10 and a 15, and then another 5, then we're starting to add a considerable amount. And then just to add one more onto it, penalty for failure to file. You can tell they're really, really serious about employment taxes if they don't file that on time. So we're talking about our 900 series, our 941, our 940s, 944s, 945s. They don't file that on time, 5% of the amount shown on the return for each month the return is late is going to be tacked on there. So this maxes out at 25%, so we're talking 5 months' time. You can imagine if you have somebody that says, I can't afford to pay. Well, at least if you can file on time, you're going to save yourself a potential 25% penalty down the line. So we're looking at a huge amount of penalties that can be tacked on, and the best thing that somebody can do is just be compliant.